Welcome to Financial Planning Explained, and I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm happy to be joined again today with Nick DeVito, who is also a certified financial planner and one of the minority owners in the firm. And at some point in time, hopefully you'll be a majority, right?
That's the plan.
That's the long-term plan. But anyway, Nick, thanks for joining me again.
Thanks for having me.
So this is part two, where we're talking about company stock plans. In the first episode, we talked about those that are in the non-qualified arena, meaning that they're not in your retirement plan. We talked about RSUs, which are restricted stock units. Those seem to be the ones that are most prevalent. Okay. Then you got stock options, which are the incentive stock options, which are definitely old. You have the non-qualified stock options. And then we left off last episode talking about the employee stock purchase program, the ESPP. One of the things that we always talk about, anytime that you have any type of plan through your employer, the employer is required to maintain a document called the summary plan description. The summary plan description is basically the rule book of the plan. There's a rule book for your 401k. There's a rule book for your ESPP. There's a rule book for your restricted stock units. There's a rule book for your stock options. There's a rule book for your pension. There's rule books for all of them. And don't let the word summary plan description fool you. You'd think on the surface it's 3 or 4 pages.
It's not. Oftentimes it's not. I think we saw one the other week that was 14 pages.
14?
And we said, wow, this is actually a short.
Yeah.
This is a short one.
I usually find them to be 60 to 100 pages, which is, in my opinion, ridiculous, but they forgot to consult with me when they made them up.
Yeah, exactly. So, they didn't ask you.
Anyway, so what we're going to talk about now is the ones that are in qualified plans. Okay. The first one you don't see often. It is relatively complex as far as its establishment, but you as the employee don't really need to care about it. It's an ESOP. That's an employee stock ownership plan. Okay. And typically that is created by a private corporation, although public corporations do it too. Okay. But what a private corporation does is it's a way for the business owner to get out and to be able to take his company and sell it. And what they do is they go to the bank, borrow the money, and what ends up happening is all of the employees effectively own the shares. Mm-hmm. Okay? But they own the shares inside their 401k. Yep. Sort of as a separate piece of the 401k.
You'll see both. Sometimes it'll be directly in the 401k. Sometimes it's its own separate entity. And like I have a client right now who that's the case for her. She has her ESOP and she has her 401k. They're separate from one another. Oftentimes what you'll find with the ESOP is, at least in my experience, the employee isn't making contributions to the ESOP.
That's correct.
Typically, the employer is the one that's making the contributions, and you're receiving a certain number of shares each year. And then at the end, you have the ability to, when you're withdrawing from the ESOP, they sell the shares and give it to you in the form of cash. If it's a private entity, typically what'll happen is you can't choose to walk away with the shares. They'll only give you the cash equivalent of those shares. With a private company, they're going to be evaluating the company every year to determine the value. That valuation multiplied, the share price multiplied by the number of shares determines how much you actually have in your account.
I've seen and worked with a handful of ESOPs. And what I've found, with the one exception, is that these ESOPs make money hand over fist. A good one is Wawa. Okay, Wawa has a nice ESOP. And, Wawa is a terrific company. I mean, they have that great business model. They have the gas stations, the super gas stations, and, cigarettes at the lowest price, gasoline at the lowest price, because they try to attract you into the store where all the high profit margin stuff is.
Yeah.
Okay. Wawa's got a terrific business model and they have a wonderful ESOP. And if you've been at the company for a long period of time, you never contributed a dime to that ESOP, you retire with oftentimes a couple $1 million.
Yep.
in your ESOP. And your ESOP basically is like a 401k. Now, going back to the rule book, okay, each ESOP's a little bit different. Okay, got the one client who has an ESOP, and they said prior to the age of 60, between 55 and 60, you're allowed to take 25% of it out, but all you're doing is diversifying within your 401k. So if you have let's say a $400,000 ESOP, you're allowed to take up to $100,000 to diversify it. They give the ability to do that because they realize for a lot of people, that's all they got. Mm-hmm. And if you're all tied into one company stock, that's pretty risky. Then what happened in this particular case is once he turns 65, he's forced to take it out and has to take it out over a span of 5 years. You have to take 1/5 out, then 1/4, 1/3, 1/2, and then the entire balance.
And I would say that's pretty common with ESOPs. You'll see that it's usually you can't liquidate and take everything out at one time. It really depends. To Mike's point, they're not cookie cutter like 401ks may be. They really do vary, but the ones I've seen, there's been a distribution schedule like that where it's, okay, you get to take 1/5 out every year. You can't just go in and say, I'd like 100% at this point in time.
Right. Although they are the one with Dana. It's 5 years. It's spelled out 1/5, 1/4, 1/3, 1/2, 1. Then I got Dan's. He has to wait until he's 65 unless you terminate employment. Mm-hmm. Okay. If you terminate employment, then it's 5 years from that time.
Yep.
But if you're 65, you have to take it out and on the schedule of 20% per year. That we've got another one that Wawa says you have to take it out within 5 years, but you can wait until the end and take it all out. But what happens is it behaves like a 401k. And what do I mean by that? It's a pre-tax asset, okay? And as a pre-tax asset, you want to take $100,000 out? You're posting $100,000 on your tax return. So you just got to plan it accordingly the same way. You want to roll it into an IRA, you can do that as well. So you just got to plan it accordingly. So the other one, which is similar, and to Nick's point, they're usually either inside the 401k from the perspective of you get your $1 million statement and 400,000 says your ESOP, or two separate plans. You got the 401k over here and the ESOP over here. It all depends on who's administering it. Okay. A lot of times the 401k will administer both. The other one is a lot of companies allow you to buy stock inside your 401k. You want to pick it up from there?
Yeah, sometimes you'll have the ability to buy your company stock in the 401k. You can elect that. It's one of your investment options. I would say typically you're going to see that with your publicly traded companies. Right. I'm not saying never, but it's very rare that you'll see it for a privately held company. Your large companies of the world may have that available to you. And there's special rules that go along with it, particularly when it comes to Net Unrealized Appreciation, or NUA. This is an alphabet soup episode. RSU, ESPP, ESOP, 401k, NUA. But anyways, Net Unrealized Appreciation, or NUA. Let's say you've been buying your company stock all these years on the pre-tax side of the ledger, and you've put $100,000 in, and the company stock portion of your 401k is worth $400,000. You have the ability, when you're rolling the money out of your 401k, to elect NUA for the company stock. What that will do, if you elect that, you roll your whole $400,000 out. You pay taxes on your cost basis, the money that you contributed. So you put in $100,000 over those years. You pay your ordinary income tax on the $100,000 you roll out. Now your stock moves into an ordinary investment account, not a retirement account, not an IRA. It's a regular investment account. So now you have a stock with a $100,000 cost basis and $300,000 in long-term capital gains. The reason that's advantageous is due to the tax treatment of long-term capital gains versus ordinary income. Your long-term capital gains are always going to be taxed at a lower rate than your ordinary income tax brackets. So in that example, what did you do? You moved $400,000 worth of assets, which you would have paid ordinary income tax on for every dollar you took out, into a regular investment account where now you're paying the reduced capital gains rate on $300,000 worth of it.
And there's a lot of nifty, cool things that go along with that as well. For instance, using that same 100,000, 400,000, I can gift the stock, but I can't gift the 401k. So if I wanted to use charitable distributions, if I wanted to gift the stock to a charity, a lot of people do. We do this with a lot of clients. They routinely tithe to their church. Great. They tithe $3,000 a month. Great. Well, I got a better idea. Why don't we tithe $3,000 of that stock? Okay, because now what's happening is they got this $400,000 worth of stock that has $100,000 in cost basis. Let's just slice it and say $4,000 worth of stock has $1,000 in cost basis. Push it to the charity. And why do you stick the charity with the tax?
Because they don't pay taxes.
Exactly.
We're not bad people, I swear. It's tax planning.
So it gives that ability. It gives the ability for you to gift the stocks to your children. I see that often. Your children, your grandchildren, okay? Because you figure if you're rolling it out of your 401k, the odds are you're retiring, okay? So if you're retired, odds are you probably have grandchildren. So it's your way of being able to gift assets. It's your way of being able to donate assets. And it's also your way of, if you die, your beneficiaries inherit the entire 400,000. All the gains are gone.
Yeah. And when you're weighing out whether or not to do NUA, there's a few factors that you're going to take into consideration. One, what tax bracket are you currently sitting in today? Because whatever your cost basis is, you're paying the ordinary income tax on that. Two, you want to look at the difference of your cost basis versus what it's currently worth. You want to evaluate the gain, because let's use that same example. You have $400,000 of company stock. Well, if your cost basis is $350,000, you're really only saving on the $50,000 at long-term capital gains. And then you have to weigh, well, is it worth me paying tax on $350,000 now to save on $50,000? Might not be. Where it's really advantageous is where there's a massive difference, where your cost basis is low and it's grown a lot. That's where you see the most benefit to it.
By the way, I do have a client who had it in private. Okay. Yeah. And they had, and this will go a little bit into the second episode or the second segment. They did, in their cost basis on shares are like $15 or $20 a share. Their cost basis was less than $1. Okay. Because they kept splitting and splitting and splitting and splitting. They were contributing to their 401k. They were able to roll out something like $100,000 worth of stock, and they paid like $8,000. The other thing to point out, there are a couple nuances with NUAs. For one, and I got almost tripped up on this. Okay. I don't know if I told you this story. I had a client who retired from Boeing, and we did the NUA. And this is one of those examples of, I always say, show me the stuff, because we did the NUA. And when I looked at the stub, I'm like, this isn't right. And I thought they screwed something up. So we called the company, and it turns out that the client about 3 or 4 years earlier took a distribution from the IRA, or from the 401k. And so that there demonstrated the rule of, if you retire, okay, rule is usually you can't grab the NUA unless you're terminating employment and rolling the money out. But it needs to be done in the same year as any withdrawal. Because if I took a withdrawal last year, NUA is off the table.
Yeah, and it's an all or nothing from the standpoint of, if you're electing NUA, you have to be rolling out or distributing the whole value of the account. I ran into that
within the same year.
Within the same year.
Right.
So you can't say, okay, just give me my NUA portion, I'm going to leave the rest in the 401k. It doesn't work like that. Now, what I will say is, I have run into, and this is where it gets plan specific and company specific, is it's not all or nothing from the standpoint of, let's use that $400,000 example. You don't have to do NUA on the whole $400,000. You can say, okay, I want to do half. Now they're going to use the average cost basis most likely, but you'd have $50,000 cost basis for $200,000 worth of stock, and the rest just goes into your IRA, and you lose that NUA ability. Once it's out of the 401k, you can't do that anymore. Just keep that in mind. So there is a little bit of nuance associated with it. And it's not It's not super complex, but you want to know the rules before you're doing anything.
One more rule to know. I knew the rule and we did it anyway. Okay. Is the NUA is considered to be a distribution, which means that if you're under 59 and a half, or shall I say, if you terminated employment over age 55, it's allowed. But if you're subject to a 10% penalty for taking money out of your 401k, then guess what? That distribution of NUA is considered a penalizable, subject to the 10% penalty. Now, in the one case that we did it, I had a client who was 57. She received this particular 401k from her spouse as part of a quadro, but inside it was the stock. But she was cash poor, IRA rich, and she needed money. And so what we were able to do is we were able to do the NUA. We did the NUA. It was like 15,000 on 120, which is a beautiful thing, by the way. So we were subject to tax on the 15,000 plus a 10% penalty. So it's $1,500 of money that I did not want to spend. But what it did is it freed up 120 grand of monies that she needed prior to turning 59 and a half. So, there are times you take the penalty. Okay. In her particular instance, it was worth it, but you just need to know the rules of the game before participating in the game. So I'm going to stop there. We'll take a break and we'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. And what we're going to do is we're going to finish up and wrap up the discussion of company stock plans. We see this so often. I mean, the one group over at the one company local. Oh my goodness. Concentration risk is what we're going to bring up. What you find a lot of times is all of these programs are awesome. Okay. RSUs are awesome. And by the way, who gets the RSUs? People making decent money. And they're getting decent amount of RSUs. And to be honest with you, it's a cashless exchange. It costs you nothing to buy them. As I indicated with that one who had $136,000 in company stock, didn't even know he had it. Okay. So it's a terrific way with RSUs to accumulate a lot of stock. The ESPP, it's a terrific way, just like your 401k, to sit here and contribute a percentage of your salary to accumulate stock. Okay. Stock options, not really, because they have a 10-year vesting schedule. But if you're within that 10 years and you've been given stock options and you have all those other things and you're contributing to your 401k, and you got an ESOP, but I'm not even going to go there because usually you don't see it. But you could have all four of it, and it is remarkable how often we find people accumulating an enormous amount of stock in their own company, just one company. Okay. First of all, it's a concentration risk. All right. Secondly is that's like a triple-edged sword. Okay. Because the viability of your job and your income and your bonuses are impacted by the performance of the company. And do you think the performance of the company is going to have an impact on your RSUs and your ESPP and the stock inside your 401k? You got everything. You're like all in.
Yeah, and sometimes it's intentional and sometimes it's unintentional. I've seen both ends of that spectrum. I'll see some clients that, to Mike's point, they've just been participating in these great programs all these years, and we finally take a look at that and we say, "Whoa, you have a very high concentration to your company stock." We have others that say, "Well, I love my company. I want to have that high concentration," but there is obviously a risk associated with concentration risk in any stock. But to Mike's point, it really hits home with your employer stock because let's say you lose your job, for example. Well, now your income that you were receiving was from that company. You no longer have that job. Oftentimes, if you lose your job, anything that was unvested, you lose. So that's another issue. And third, if the company's doing layoffs, that could negatively be impacting the price of their stock. Therefore, if you had money in your 401k or you were holding company stock, the value of those shares go down. It's all relative, but I think for me, a comfortable range I like to have is at 5 to 10% of your investable net worth. I'm okay with having 5 to 10% if you think the company's going to do well. That's not an unhealthy amount. We've had someone who come in with 80, 90% of their entire net worth was tied up in their company stock. That's where you're playing a really dangerous game. Sure. Could it be beneficial to you and the company takes off? Absolutely. But you're really putting yourself at risk there. I had an example last week where they had 20% of their investable net worth was in company stock. And I looked at them and I said, well, how does that make you feel? I kind of start with that. Well, how does that make you feel knowing 20% of your assets are in your company stock? And going back to something I said in the first episode was, if I were to give you $10,000 to invest, would you buy your company stock? If the answer to that is no, then maybe you should consider selling some of the company stock that you have. Now, where you do it, there is a strategy behind that. For example, we were talking about the NUA within the 401k. Well, that's a place where if you're going to hang on to it, maybe you look to hang on to it there because of the benefit of the NUA. You're still going to be invested in your company stock, but you're also receiving the benefit of the NUA, where if you're participating and you have the RSUs, ESPP, or stock options, you can really diversify with little to no risk there. You're not missing out as much. So it's really something to keep in mind, and it's a dangerous game. And I know Mike talks about this all the time, is people have a propensity to drink the Kool-Aid because the company's always going to want you. I mean, sure, as a member of the company, as an employee, you're going to have a little bit more insight, but the company is always going to be promoting growth. The company is always trying to grow. They're never trying to fail. They're always trying to grow. So you got to be careful about getting wrapped up in it and really take a step back and say, okay, how much of my net worth really is tied up in the company that I work for?
I had that happen with me with one client who had $880,000 between his 401k and company stock. 850 of that 880 was in that company's. That's 96%. And he said, oh, yeah, everybody does it around here. In fact, he says, you know what some people do? He says they take their stock and they have the ability to take a loan against the stock, right? And you can borrow up to 90% of the value of the stock. And you know what they were doing with the loan?
Buying more stock?
Buying more stock. And they're like, all right, that's a little risky. And, people with Enron used to do that. Okay. And then Enron stock crashed and look what happened. People literally committed suicide on that.
Well, that led up to a bunch of new laws because I believe what Enron was doing is they were making you keep it in the stock. Right. You couldn't get out of it. So now there's all these rules and regulations, as there should be, saying your company can't force you to keep money out. The ESOP is a different entity, but within the company stock in the 401k, they really can't force you to hold the company stock in there. You always have that option.
They were forcing you to buy the stock, and then they put a freeze on it that you couldn't sell it. In all of the months that it was going down, they did not allow you to do that. Now, one of the rules that went away is they threw away the rule that you had to contribute to the company stock, but understandably so, they kept the rule in place that the company could match, like, your standard match, 3%, 4%. They could match in company stock. Yeah. And I'm okay with that, especially if I can sell it.
Yeah. But going back to what we were talking about, always keep an eye on that concentration risk and how much you have in there. And another important consideration we talked about earlier was you don't want to let the tax tail wag the dog, because, okay, maybe you want to be diversified, but you're like, oh, well, it could go up more, or I don't like what it's going to do to me from a tax standpoint. But you can very quickly see the benefit in tax savings diminished if the company stock plummets.
Oh my goodness. Yeah.
So you want to be very careful about that. And going back to the conversation I had last week, I said, look, where you're at, you're probably never going to be in a lower tax bracket while you have these options. I know it's not fun to pay the tax on that, but I think it's beneficial that we exercise some of these options and diversify away from your company stock.
By the way, that individual who had that stock back in 2004, the stock price was $85 a share. It's $85 a share today.
Yeah.
It got up to 250, but dropped back down again.
Yeah. And that's the risk you run with individual companies,
right,
where you can see a very nice run. But what I will say is you just got to be careful. That's really all it comes down to. You got to be careful.
And, one of the things, going back to NUA, fact of the matter is that the financial institution is required to maintain records as to what your cost basis is. So you don't automatically jump on NUA. You want to know, and again, any decision you make, you want it to be an informed decision. So you can call the company, whether it be Empower, Fidelity, Vanguard, wherever it's held, just call them up and say, what's my cost basis? And my company stock. And to Nick's point earlier, if you're trying to reduce the amount of exposure you have to a particular company's stock, if the cost basis in your 401k is higher than the value of the stock, that's one mighty good place to go ahead and liquidate it, because there's no taxable event inside. Okay. Sometimes you may say, hey, I got company stock outside the plan. If I sell it, I can write off a loss. That's another opportunity. Yeah. So as you can see, there's a lot of different things to take into consideration. And it's always just a good idea. It's always a good idea to know what you have going on and know the rules of the game, because he who knows the rules of the game the best has an edge in the game.
Absolutely.
Good concluding point right there. So I hope you learned something about company stock plans. A lot of people have them. And actually, a lot of people have ESPPs and don't take advantage of them. I think that's crazy, because it's a great opportunity. It's a great opportunity to be buying stock inside your 401k because of the possibility of NUA when you retire. And so there's, these plans are given to you as an opportunity. Take a look and see what they are. And if you have any questions, we encourage you to give us a call. We'd be delighted to walk you through it, talk you through it. Our phone number, if you wish to reach us, is 610-422-3773, or our email address, our web address is www.MAA, as in like Menninger and Associates, www.maaplanning.com. So thank you for joining us. Thanks for participating, Nick. Appreciate it.
Thanks for having me.
And look forward to seeing you in the next episode. You have a wonderful day and week. Thank you.